As we all have a debate over what a recession is, this market is poised for its biggest monthly gain since November 2020. Futures positive this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. Is bad news good news?
Bad news is good news.
I hate that conversation, honestly.
Is bad news ever really good news?
Oh, I think so.
In terms of how the stock markets are reacting and how bond yields are moving.
Jay Powell offered something to the market.
Seemingly quite a dovish tone and rhetoric on Wednesday.
I feel like they induced this rally.
That's provided that trigger for risk.
What I heard was there's no more guidance because we're tired of being wrong.
The market just breathed a sigh of relief that really wasn't necessary.
Bad news is always bad news.
The reaction is to a weak GDP report.
The market reaction.
None of that's positive to me.
I'm with Dan Suzuki. I hate this conversation too, and so does Mohammed. He joins us right now. Mohammed El-Erin of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, let's just start with this ridiculous, tedious recession debate. What's your take on it?
I think, John, it's that we have triggered the technical definition of recession, but the analytical definition, which most economists embrace, suggests that we are not yet in a recession, but the risk is high.
Is that where we're going, though, Mohammed, from your perspective?
I think the risk is high. It is not preordained. There are things that can still be done to stop us slipping into a recession. But I think the two key questions, John, that we're going to be talking a lot about in the next few months is if we end up in a recession, how shallow or how deep is that recession? And secondly, how sticky is inflation on its way down? And I'm yet to hear any compelling argument that says we know where we're going in terms of growth and we know where we're going in terms of inflation. I think there's a lot of uncertainty ahead.
Well, you know what the consensus is. The consensus view is inflation's going to come down, Mohammed, based on what we've seen through commodities. And the consensus is if we get a downturn, it will be shallow, it will be short. What are the risks around that view?
So first, I think the consensus is headline inflation is going to come down, and I agree with that. But core inflation is a different issue. I think we will find that core inflation is going to be much stickier than what we see on the headline inflation. On the recession view, I think Rich Miller of Bloomberg had a really good article a couple of weeks ago saying, how did we get to that conclusion that recession will, by definition, be shallow? We don't know, John. We are in uncharted territory. Let's hope we don't get into a recession. But if we do, it's not clear to me what that recession is going to end up looking like.
Mohammed, in the meantime, you know how this market's been trading off the back of it. Bad news is good news. This was Jonathan Golub of Credit Suisse. He said this: whether or not we're in a recession will be debated by academics. The GDP report unequivocally reflects a substantial weakening in economic activity. He went on to say, raising the likelihood of a dovish pivot by the Fed. For now, bad news represents good news for stocks. Mohammed, what do you make of a month that has been pretty weak on the economic side and pretty strong on the market side?
So it's a reminder that there are three influences on markets at the macro level, and the economy is just one of them. You know, you have fundamentals, and if you were to just focus on the fundamentals, then you wouldn't be able to reconcile a pretty terrible month for the global economy versus a really good month for markets across the board. But remember, the market is not the economy. There are two other things that played in. One, it's technicals. There was lots of cash on the sideline. The risk conditioning is good at this stage. You had a good foundation for people to buy, and you have a lot of liquidity. And then there's the relative valuation argument that kicked in as well. So we get these episodes where the second and third determinants of asset prices overwhelms completely the first one. It often happens, John. Over the longer term, however, you need all three to be aligned.
Michael Hartnett came out this morning over at Bank of America, Mohammed, and said it's too early to price the Fed pivot. He's saying sell the S&P at 4,200. Is it too early to price this Fed pivot, given everything that we don't know and that you just explained in the last 3 minutes?
So there's two reasons to price the Fed pivot, both of which are weak. The first are weak in terms of if you want to translate it into it's good for risk assets. The one is that we're going to have a very deep recession and the Fed is going to have to stop. Well, if you're worried about a very deep recession and the Fed is going to have to stop, then you shouldn't be buying risk assets here. Just wait. You'll get better valuations. The second argument is that Chair Powell, in his unscripted remark, said we are at neutral. Now, if you believe we are at neutral, then the scope for soft landing the economy goes up significantly. And then that's the reason why you would get the pivot. So you have to decide why is it that you believe you're going to get the pivot. And if it's the second reason, you've got to be clear in your mind that we are at neutral. My own instinct, John, as you know, is that the zip code for neutral is above where we are now.
How much further above?
At least 0.5 percentage points. And as everybody acknowledges, they're going to have to, including Chair Powell, they're going to have to go beyond neutral. So I think the market is looking for a pivot at a time when the only reason you would get it if the economy completely collapses. And if that happens, equities may not be able to withstand that. So I think all these, it just shows you how much uncertainty. And let's not forget what you pointed out is that we have so much that's going to happen between now and September that even the Fed itself, I suspect, doesn't know what it's going to do in September.
There's a ton of economic data still to come. We're looking forward to that. Mike McKee's going to break it down for us. Mike, futures this morning, positive, but fading off the back of the data from 36 minutes ago.
Yeah, we've got a number of indicators out today that tell sort of a mixed story about what's going on in the economy. You take a look at where we are for ECI and PCE, the two big numbers that came out today. And we see that wages are still rising in terms of the ECI, the quarterly look at wages and salaries, up 1.4%. That's a fairly strong level. It's up from last quarter, the first quarter. So is that contributing into where we are with inflation? Hard to say at this point because, Mohammed mentioned the fact that he thinks core is going to be sticky, but you take a look here and the wedge between core and headline inflation in the PCE is widening. The PCE number only up by 4.7%, 4.8% for the core, 6.8% for PCE inflation. So we're not seeing the core rise as much. And then the hard part with this PCE number is that's going to include all the data that came in on energy prices in June, which have now reversed. So are we going to start seeing the headline number come down as well? ECI, as I mentioned, personal spending up 1.1%, fairly strong. The shift to goods, from goods to services did not take place. Goods still well outpacing services in this month, but the savings rate drops to 5.1%, and that could be key in the long run if people are starting to run down their savings and not spend as much money. On a real basis, the spending was actually negative for the month. Month was down, was 0.1%. So we're not making as much as we thought. You look at inflation and spending at this point, and you can see the difference there between the nominal number and the real number, and it is quite a wedge. Inflation is still a major issue here and affecting all these numbers.
It's a massive one, a massive issue. Mike, I know you're going to be back with us in about 30 minutes or so to talk about more data, and then we've got you, Mitch, at 10 Eastern time. Mohammed, I'd love your view on that. Real versus nominal. Nominal GDP is flying for obvious reasons. Real GDP is contracting. How rare is that? And from your perspective, how will the Fed be thinking about that?
We don't see it very often in mature economies. We see it all the time in developing economies. So it is strange. How will the Fed react? How it should react is it has to put the inflation genie back into the bottle. That is its most important task. Its dual objectives are clear. Its own measure, its own preferred measure is more than twice higher than where it wants it to be for price stability. And the employment side, if you stick to what they're saying, is very tight. So it's clear what they have to do. Let's just see if that's what they're going to deliver.
So has this market misinterpreted what this data, GDP yesterday, means for this Fed?
I think the market has run to the conclusion that it wants. before the Fed gets there. Now, it doesn't mean the Fed may not get there. Okay, if you believe that the Fed can soft land that economy, the Fed will get there. But the market has gotten there, I suspect, way ahead of what the Fed is. Remember, John, and this point you've covered, we are significantly loosening financial conditions. And that's not what the Fed wants to see right now.
So, Mohammed, just to make it even more complicated, and forgive me, the quicker the market gets there, does that make it harder for the Fed to actually get there itself?
Yes, some have even suggested that the Fed may have to point out that it didn't want the market to go where the market has gone. Now, that's really tricky to do, and it's very, very delicate. But yeah, I think this is for the Fed, where inflation is still a big issue, this is a premature easing of financial conditions.
The trader in you, Mohammed, would you fade the move over the last couple of days?
Look, I would respect the technicals. I think technicals are really important. So I wouldn't fade it immediately, but I would be looking to fade it if I felt that the technicals were weakening. I know that's not a concise answer, but you've got to respect the technicals.
Futures fading just a little bit right now, positive by 1/3 of 1%. Mohammed, we get really lucky catching up with you twice in a week. Thank you for being with us, sir. A good friend of this programme, a good friend of mine, working through some big issues in this market. Let's get you some movers ahead of the opening bout. We can do that with Abby. Welcome back, Abby.
Thanks so much, Sean. It's great to be here. And it's interesting because futures may be fading, but that's not true for big tech. And one message from some of the big tech earnings may be better than feared because we have some mixed messages. But nonetheless, Apple and Amazon together poised to add more than $220 billion in market cap. Investors really focused on the future. That's true for Apple, focusing on CEO Tim Cook's nod to improving supply chains in China and the idea that iPhone sales may be better at the end of the year, looking past the fact that earnings in the past quarter were down 7.5%. That's true, too, for Amazon. They posted the fourth straight quarter of earnings falling on a year-over-year basis, but they did beat sales by 1.4% and guidance for 13 to 17% sales in the third quarter. Investors like it. Not liking it, though, Intel plunging down 11%. This is a bit of a shocker as they posted a net loss and the biggest decline in quarterly revenue in more than a decade, about $15 billion in revenue, missed by 15%. They cut the forecast, but the CEO is saying it's a bottom. Let's see. And then finally, rounding it out, ExxonMobil earnings missed slightly, but they were at a record, sales missed slightly. Earnings beat, and they were also at a record. They held the buyback. This stock on into today, up more than 50%. Investors continuing that trend.
Abby, thank you. Coming up on this programme, it's the debate over the R word.
There's going to be a lot of chatter about whether we are in a recession. The Fed Chairman Powell made it clear that he doesn't think the U.S. economy is currently in a recession.
That doesn't sound like a recession to me.
That conversation up next.
There's going to be a lot of chatter today on Wall Street and among pundits about whether we are in a recession.
We are seeing a slowing in the economy and in demand that's appropriate and necessary.
Both Chairman Powell, banking personnel, and economists say we're not in a recession.
Our unemployment rate stands at 3.6%. Household finances are strong, and industrial output continues to grow.
That doesn't sound like a recession to me. Thank you very much.
A partisan debate heating up down in D.C. The White House rejecting claims the U.S. is in a recession. Republicans firing back.
We are in a recession.
We are now in a recession.
Democrats have plunged America into a recession.
The Biden administration has been in denial. This news is a grim milestone that points towards more hardship, more suffering, and more pain for the American people.
Today's Democratic Party is a walking, talking economic disaster.
Joining us now in D.C., here's Anne-Marie.
Well, John, you heard it there. It's a battle for the branding of what the state of the U.S. economy is currently in. You have the president, you have the Treasury Secretary saying, look beyond this back-to-back contraction in GDP growth. Please look at household balance sheets, look at the unemployment rate, look at foreign investment. And then you have the Republicans saying what we have right now is 2 back-to-back quarters of negative GDP growth. For many, this has been deemed a, quote, technical recession, and that's what we should call it. Even 3 of them, Jonathan, had gone so far to some of this political theater saying they should affirm the definition of a recession in a resolution in the Senate, and saying that what the Democrats are doing and the White House is doing is trying to rewrite history to avoid bad headlines. Of course, for everyone, this is ahead of the midterm elections.
Anne-Marie, it's all about politics. It always is. Down in Washington, D.C. Yeah. Thank you. Joining us now, Emily Rowland of John Hancock, Canaccord's Tony Dwyer. Emily, straight to you. This market rally we've seen, is this something you want to bet on or bet against?
I think investors are a little bit too optimistic right now, John. You know, clearly economic growth here is on a path of decelerating. We've seen earnings estimates rolling over. Of course, Q2 earnings season coming in a bit better than expected given that low bar. But look, if we're not already in a recession, we're going towards one. Again, this is an environment that you want to notch up on quality. You don't want to be adding a lot of risk to portfolios. And that's exactly what investors have been doing here over the last couple of weeks here. It does not fit with the macro backdrop.
Tony, you've said it. No longer extremely oversold. Tick. The fear of the Fed abating. Tick. Hope for a soft landing is pervasive. Your words. Tony, why do you think that's misplaced?
So you're spiking rates to a historic degree into a generationally levered system with bloating inventories and slackening demand. How's that for a summary, buddy?
So you're fading this move, Tony. Is that what you're doing?
So what we did is we came up with an indicator. We found that since 1957, anytime that the S&P 500 10-week rate of change dropped to minus 15 or worse, in other words, down 15% in 10 weeks, that's what we call a whoosh. And then you pivot to the point where that indicator, again, it's a simple rate of change you can get on your Bloomberg, pivots back to above minus 10. Historically, that's only happened 16 times, John. And when that's happened in the past, it's always retested the low unless the Fed has already started easing. Clearly, that's not the case. So what we see is you get a median gain once that indicator goes off of about 5%. We're up about 5%. So if you follow the course and go down to retest the low, you have maybe 1% upside and 10% downside just to test that low.
Emily, are you expecting some Fed speakers to come out in the next week and push back against some of this?
Yeah, I mean, the markets heard something very different than what I heard from the Fed on Wednesday. I heard Jay Powell reiterate the fact that they are willing to risk a growth slowdown, potentially a recession. They're willing to risk unemployment rates going higher in order to stamp out elevated inflation. And the Fed is now putting as much tightening into the system as we've seen in decades. At the same time, again, that economic growth is cooling. So to me, we're going to be listening closely for signs of can we really start to understand that message a little bit better? And to me, I just don't see the pivot that everybody's talking about.
Emily, is it all about rates? Where does earnings fit in here, given what we've heard from the big tech players this week?
Yeah, I mean, again, I don't know that markets care all that much about earnings right now. We look, of course, expectations were for around 5% earnings growth this season. We saw 6% so far on a blended basis. Tech companies are coming in. There was a lot of concerns about supply chains, a lot of concerns about the resilience of the U.S. consumer, the stronger dollar. And it turns out that earnings were good enough to assuage some of those concerns. But we think that those challenges continue to build over the quarters to come. And we watch next 12-month earnings growth estimates, and those are rolling over in a pretty significant way. And the interesting part about that is prices are going up. So that's your numerator. And your earnings estimates are going down, your denominator. And that actually is causing PE ratios to rise right now. So really notable dynamic playing out. And I think earnings are the most important driver of stocks and profitability over time. So you've got to find parts of the market that have better earnings quality as we head through the remainder of the year.
So, Tony, right now we're trading on lower rates. There is a fear that we'll start trading on why rates are low. And, Tony, with that in mind, how would you use this strength to reposition?
Which lower rates, John? I think Emily's right. You're still spiking rates. And again, there's two kinds of fear. There's a fear of what the Fed is going to do to economic activity, and then there's the reality of the economic activity. And this is traditional what happens when the Fed spikes rates. You get that first leg down, which is the fear of what it could mean. You get this feeling like, okay, it's okay, the long end stopped going up and it's actually coming down. And then you get that economic related drop. So our call, as you know, John, this year was stay out of the way, even anticipating the summer rally, which as we discussed earlier, looks like it's pretty much met its target. So what we would do is on any further strength or even here, we would, if you bought for the summer rally, maybe lose those positions. And if you haven't and you wish that you were a little bit more defensive 2 months ago, maybe it's time to get a little bit more defensive. Again, there's two fears, the fear of what could happen and then the fear of the reality of what's happening. And ultimately, like I said before, John, they are spiking rates into a generationally levered system with spiking inventories and slackening demand. And that is not great, as Emily outlined for earnings.
And given the data we've had this morning, it looks like they're going to go again in September. By how much, it seems to be the debate. Tony, I know you've got to run. It's got to catch up. Tony Dwyer there. Emily Rowland's going to stick with us around the opening bell. We'll get you some of those big tech moves in just a moment. Moments ago, Bank of America published. They said strong hiring and falling GDP mean an unsustainable collapse in productivity. The labour market should slow quickly soon. They say the Fed is likely to respond slowly to a recession. Mike Gapin and the team pointing out, we think market optimism around a dovish Fed and a dovish Fed pivot is premature. Their words. Coming up, the morning calls, and later, Tim Cook delivering in Top Gun Maverick fashion. The words of guess who? Dan Ives of Wedbush. He'll be with us shortly. The gains fade just a little bit. Let's get you some morning calls. Baird downgrading Intel to neutral, growing increasingly concerned about the macroeconomic backdrop. Barclays raising its Amazon price target to 200, highlighting its robust platform and accelerating growth after earnings. Evercore raising its Apple price target to 185, saying the company remains well positioned to continue reporting impressive sales growth. Resilience, the word I keep hearing. Coming up, Amazon and Apple set to add roughly $190 billion in market value after earnings. Dan Ives of Wedbush joins us next. Let's wrap up a busy trading week. 20 seconds to go until the opening bow this morning. Good morning. 2 days of really powerful gains on the Nasdaq and on the S&P for that matter. Can we make it 3? Futures up 0.4% on the S&P, on the Nasdaq 100 higher by 5 or 0.6%. The Russell just squeezing out a small gain, up by not even 0.1%. There's your opening bow. Switch on the board and get to the bond market. Line of the morning goes to Michael Harnett of B of A. Dove at first sight was the title of his Flow Show report this morning. Yields higher by 2 basis points on a 10-year, 269.93. It's the story of the week, isn't it? Weak economic data, yields lower at the front end because people believe the Fed's going to back away, and then a whole host of guests on this program say, no, not too fast. Euro dollar, 101.58, negative 0.4%. CPI hot, GDP okay for the Eurozone. Not for Germany. They're looking at a stagnating economy and really hot inflation. And how many times have we said this about the ECB? Somewhere between a rock and a very hard place. Crude, 99.79 higher by 3.5%. That's the cross-asset price action. Let's get you some movers. Here's Abby.
John, lots of earnings movers to get through. Some leaders and laggards, starting out with what's working, not surprisingly, big tech. We have both Amazon and Apple up sharply. This after both companies put up interesting quarters where quarterly profits, the growth declined, but you had some positive spots for Amazon. That was sales beating by 1.4%. Better than feared, really, is one way to describe it. Guidance was strong for Apple, of course. Tim Cook, the CEO, very strong in the end of the year in terms of of iPhone sales could really be even more improved. Also optimistic about supply chain constraints in China perhaps improving. Intel, though, not so much. A disaster, down 11%. Huge misses, a surprise loss. The biggest revenue drop in more than a decade. They cut guidance. Investors clearly not liking it. And Roku down 24%, the worst drop ever going back to 2017. A mixed quarter, just a bad quarter, wider loss than expected as ad spending slows. However, the energy complex, very strong. ExxonMobil, Chevron, Phillips 66, all put up very strong quarters, buybacks in place. Procter & Gamble, though, John, of course, you've been having this debate on the consumer and the recession, whether or not it's a recession. Well, Procter & Gamble, as you know, that stock down 4.7%. Management is talking about slowing growth as consumers pare back. Those are on staples products, so that could be some sort of a warning looking ahead.
Abby, thank you. Some big movers out there, including Amazon. This is a third straight day of gains. Over the last 3 days, that stock is up by about 17%. That is about $200 billion of market cap in that one name alone over just 3 days. And the third day is not over yet. Earlier this morning, Exxon, Chevron posting record profits. Those numbers look good. So does the stocks. Let's get to Kelly Lyons for more. Hey, Kelly.
Hey, John. Well, it's no surprise that these companies are raking it in, but even the sell side didn't expect them to rake in so much. Exxon beating its previous quarterly record by $3 billion in net income. For Chevron, their previous net income record back in 2008 was about 50% less than what they pulled in the quarter just reported. Their EPS topping estimates by about 18%. And Chevron, of course, also boosting the top end of its buyback program to $15 billion. When you put those two together with the other oil majors, we're talking of $64 billion in profits this quarter. They are just absolutely printing money. And of course, that's because their business has become a lot more profitable. It's not just higher oil prices, but also refining margins that, yes, have come in over the last 2 months, but still they are really elevated relative to history, north of 40%. And obviously all of that has translated into market performance. John, Exxon up a whopping 50% this year already, even before the gains of today. Chevron by about 30%. That absolutely dwarfs the broader market, which is in negative territory still on a year-to-date basis. So these companies are doing really well, John, and it raises a political question as the Biden administration has continually pointed at the oil sector, accusing them of prioritizing shareholders over consumers. Both Exxon and Chevron in their statements today trying to push back on that narrative, saying we're investing more, we're refining more, we're trying to help you meet demand. I wonder if we'll get any reaction from the White House over the course of the trading day, John.
I guess the good news for them is that gas prices have been going in the same direction. Kaylee, awesome. As always, thanks for being with us. Apple rolling over a little bit, positive about 1.9%. Amazon off the highs, positive by about 9 percentage points. That's a move, isn't it? John Hancock's Emily Rowland back with us. This is what she's got to say. Earnings revisions are now rolling over as analysts are incorporating lower guidance. Seeing equity markets reprice higher as estimates get slashed is an indication that investors may be overly optimistic. Emily, I'm pleased to say, is back with us for a final word. Emily, you mentioned your review of earnings. For those that missed it, let's go through it again.
Yeah, no. So again, the results are coming in a little better than expected, but they're still not great. And importantly, we look towards the future, and we do believe that there are going to be challenges continuing for companies as, labor costs remain elevated, as supply chain issues persist, the dollar continues to strengthen here. So we want to be really cautious, and we want to notch up on quality. This is not the time to own companies that need to tap the capital markets in order to see durable profitability. We would fade that part of the market. But we would look to embrace areas that have great balance sheets, great return on equity, a lot of free cash flow. And that's really where that rotation should take place. We'd even add an element of defense to portfolios. Tying it in here with the economic cycle. I know I love the last word, but I know it takes just a little bit more time to get my point across here. We do think that economic data is probably going to get worse from here. And right now investors are pricing in this idea that maybe we should be looking at buying the dip. We don't think that we're there yet. Friends don't let friends use backward-looking economic data to make decisions.
There's no dip right now either, given the move we've had since June. Either we're up by more than 10% off the lows on the NASDAQ 100. Yeah. Emily, resilience, quality. Within tech, can you help me understand where that is, where defensiveness is? Because within tech this week, we've had Facebook bad, Alphabet a sigh of relief, right? And then you've got the retail trades, you've got Walmart bad, and then you've got Amazon a sigh of relief. What is it? Where should I be?
Yeah, that's pretty notable to us. And we've been actually underweight communication services and overweight technology because in the tech sector, particularly in areas like software, hardware, you're going to find companies that, again, have that higher, more durable profitability, that strong free cash flow, lots of cash on their balance sheets, earning stability. I've been a little bit surprised by Amazon. Quarter after quarter, they show that they're not making money. Those aren't actually the types of companies we want to own in this environment. But again, those good, solid earnings growers within tech, your sort of classic technology companies, that's where we want to be right now.
Emily, you had the final word, at least after Tony. Emily Rowland, thank you. It's good to catch up. As always, let's catch up soon. Amazon up by more than 9%. Apple up by 1.6%. Better than expected results across the board for Apple and Amazon, putting the S&P on course for a third consecutive day of gains. On the West Coast, he's been up all night looking at this. Let's get to Ed Ludlow for more. Hey, Ed.
Good morning, John. The sell-side reaction to Apple is that the iPhone sales are holding strong, unencumbered by the changing global economy. The sell-side reaction to Amazon is that it is greater than the sum of its parts, that despite what we see in some online sales softness, it's helped out, of course, by AWS and by some surprise strength in advertising. But really the story here is that this is the new era under Andy Jassy. Real emphasis on cutting down operational expenses, real emphasis on investing in AWS rather than the prime side of the business. The prime side of the business, of course, was a real Bezos era priority, especially during the pandemic, where they were trying to look to fulfillment. Apple, a mixed bag. Yes, a beat on the top line, but ultimately that was supported by iPhone and iPad. Weakness and a miss when it comes to Mac and wearables, and China's a big part of this story. Overall, sales in China beat. And for a company that does not give guidance, in an interview with Bloomberg TV's Emily Chang, Tim Cook gave us a pretty good guide. In the fiscal third quarter, macroeconomic headwinds impacted the company, but things improved, particularly in China, both on the supply and the demand side in the month of June. And as they move towards that June 18th sales period, holiday period in China, there is evidence that they are strong there. They expect revenue growth to reaccelerate in the fiscal fourth quarter ending in September, and a slowdown in services, which is worth noting because the street was hoping that that would be a bright spot. But as you say, a sigh of relief. My shoulders have relaxed. A busy week.
You're done. Get some rest. Ed, it's good to catch up. Great work this week, buddy. As always. Only one man could write a quote like this. Apple's results, a Top Gun Maverick moment. Here's the quote. The street was waiting for any signs of demand issues from Apple and instead got the opposite. With China headwinds and supply chain as a peak issue in the rearview mirror for now, Cook & Co. laser focus their sights on the iPhone 14. Of course, that is Dan Ives of Wedbush, and Dan joins us now. Dan, where did that iPhone beat come from?
Look, I think China was the shocker. Down only 1% given the shutdowns. I mean, that was really surprising to the street. And I think it just shows the demand story holding up really globally. And that's something, it's a Rock of Gibraltar stock. And even in these economic storm that we see, Cook, when he talks, everyone listens. And ultimately, if you look going to September and I think year end, bark's a lot worse than the bite in terms of demand fall off. And I think that's why the stock, in my opinion, goes higher from here.
Dan, you've been a bull for a long time. I'm looking at the numbers from AT&T on T-Mobile, delayed bills. And I've been asking myself, if people are in a tight spot right now, where does your bill for the Apple iPhone, that monthly payment, where does that come on the hierarchy of things?
Look, I think even when you look at the install base, 225 million have not upgraded their phone in 3.5 years. Even if you take 5–10% off that, given some dark macro headwinds, that would be better than the street. So I think it's all relative to what was baked in here. And also services, there are a lot of worries on that. And that was much better than feared in terms of whisper numbers. I think you start to put the story into the next year. I think street's baking in a lot of bad news. And everything we've seen from Asia, iPhone 14, in terms of out of the gate, is going to be pretty much in line with iPhone 13 from units.
Dan, you've covered this name a long time. How has it stood up against a real cyclical test? And 08-09 doesn't count because the iPhone had just come out. And I don't think the pandemic counts either because we had massive fiscal transfers that supported the consumer. Dan, what have you learned over the years about how this name and iPhone sales stand up to cyclical pressure?
Look, it's been almost Tom Brady-like in terms of how it stood up. And I think that's the one thing I'd point to, is that we could talk about recession and cyclical and ultimately what we see across the board. And I just believe when I look at the ultimate demand story, what's happened on services and even some of the new products coming out next year, the chip issues are starting to moderate. And I believe this ultimately will be a stock over the next 6 to 12 months that starts to back approach $3 trillion.
You hope the peak problems are in the background. $3 trillion is a number you've been talking about for a while. I want to end up by talking about the dispersion within this sector, Dan. It's something you've been talking about too. Within tech, ad revenue versus cloud, that's only one piece of it, because I can look within ad revenue. There are winners and losers over the last week or so. The obvious losers being Snap, Facebook, Meta, another one, the winner Alphabet. Dan, what have you made of execution? I don't think execution is talked about enough. What have you made of the execution within this sector and the dispersion you're expecting in the quarters ahead?
I agree. It's a phenomenal point. I think it's a bifurcation, a parting of the seas in terms of tech. Snap was a Friday the 13th horror show. Google and even Facebook, I think, better than expected. I think what you're starting to see, tacticians like Cook and Nadella, Hall of Fame CEOs, look how they're navigating their business. Certain pockets holding up well, enterprise, cloud, cybersecurity, but others, some of the high multiple froth, no E in terms of earnings, those names could continue to sell off. And that's why I think it's a bifurcation that we're seeing in tech, led by Apple and that company in Redmond in terms of moving us higher.
Dan Ives, awesome, as always, of Wedbush. You're keeping the faith, I know you are. Others are still questioning the Apple story, and for many good reasons too. Dan, wonderful to catch up, sir. Coming up, stocks heading for their biggest monthly advance since November 2020.
The market have seen earnings that are not as bad as feared, and perceived Fed to be dovish. I wouldn't necessarily be chasing it at this point.
We'll break down the month that was and the road ahead. We'll do that with Nuveen's Brian Nick up next.
The market have seen earnings that are not as bad as feared, and perceived Fed to be dovish. I don't think Fed is pivoting here. I don't think the market is pivoting. We're going to see some of these gains taken out in the market. So I wouldn't necessarily be chasing it at this point.
More gains right now, up 0.6% on the S&P, on the Nasdaq up 1%. Good morning to you. Some breaking news. Let's get that data. Here's Mike McKee.
John, the Chicago PMI comes in down for a second month in a row, but it's still positive at 52.1. That's down from 56. A lot of people have been paying attention to the regional indicators of economic growth. This is a tease ahead to Monday when we get the ISM number, but the Chicago number joins a couple of others, Empire and Philadelphia, in being a little bit higher than they had been. And that breaks a bit of a trend in these indicators. These are all July numbers, so they're a little more timely than some of the others that we've had. We'll see what happens with the national number on Monday.
And you'll break down you, Mitch, at the top of the hour in 13 minutes.
Absolutely.
Mike McKee, looking forward to it. Thank you, sir. What a month over the last month for stocks and for bonds. Equities now heading for their biggest monthly advance since November 2020. Breaking it down, here's Taylor Riggs.
Yeah, John, and you really see on the terminal chart again that big monthly increase finally after 3 straight months of losses. So a little bit of a rebound. Change up the board as well, and you can see that it is all led by big tech. Apple, Amazon, of course, the big winners this morning. That has really been the trend of the last month, as well as big tech firmly back on top. Interesting, though, it has been a global story. Certainly not China tech participating in this, but MSCI ex-US, big rebound as well. You're finally back up about 3%, John.
Taylor, thank you. Wonderful. Looking forward to the close a little bit later with Taylor Riggs and a team. Joining us now, Brian Nick of Nuveen. Brian, first question. It's $1 trillion question. What's the difference between a bear market rally and something more durable?
Well, I think we're going to need to see more reassurance that interest rates aren't going to come back to bite us. And I think if you look at what the Fed had in mind for 150 basis points of rate hikes in about 8 weeks, probably wasn't easier financial conditions, a higher equity market, and a lower 10-year. But that's exactly what we've gotten. Meanwhile, we're still getting hotter than expected inflation data. So this doesn't feel like a stable equilibrium to me. So I guess I would say more in the kind of bear market rally, less in the durable rally camp at this point.
Brian, you've got to ask the inflation question. Any reason to believe the inflation surprises subside anytime soon, and sufficiently so for this Fed to back away?
Well, this is why we have this strange situation where the market seems to be at least occasionally cheering worse than expected data on the growth side, because it's only a weaker economy and demand destruction that's going to get us to softer, durably softer core inflation. That 0.6% core PCE rating for June, that was an eye-opener, and the people at the Fed are going to be paying attention to that as well. This isn't just the oil prices from Ukraine, Russia anymore. This is other things rising in price, and things that are harder to bring down again, like rents and like other services costs. So I think for the moment we're in this higher inflation world, and it's only when we start to see perhaps less security on the job front, people behaving less confidently, maybe saving a bit more every month, that we're going to start to see this inflation narrative come back down.
How quickly before you think this dual mandate at this Fed is in conflict, Brian? I'm hearing from Bank of America this morning they're expecting the labor market to slow quickly and soon. Do you share that view, and do you expect to see those kind of data points by the time this Fed meets at the end of September?
Well, the labor market is starting from such a strong place that even a sort of a sequential weakening, if we got, say, 150, 200, 250,000 payrolls next week, that's not going to be the end of the world. But I think the Fed's made pretty clear that they expect the unemployment rate to be going up. Now, some of that is just demographics, and we have more people moving to being out of the labor force, so that may happen, somewhat naturally. But I think as we, start to see, again, questions about company profits, large segments of the economy talking about weaker demand in the second half of the year. Why have earnings estimates turned over for 23? It's because I think a lot of firms see weakness ahead. If they start doing layoffs, that 400,000 job per month average that we've been accustomed to is going to get weaker pretty quickly. I still don't think we're in store for a sharply higher unemployment rate situation, getting to say 5.5%, 6%, which I would put in the sort of severe recession category. I think the job demand is so strong right now by employers that even a sequential weakening from here is going to let us get out of this okay on the other side, what I would say a modest increase in unemployment.
Isn't that what we're pricing, Brian? Isn't that what we're pricing now, what you just described at the end?
I think so. I think that is what's priced in, but I feel like that's also what I'm describing as sort of the best case scenario. I don't think we're going to get out of this without any change in the unemployment rate. So if you think you're priced to perfection and you're continuing to see the unemployment data, the ECI number this morning was really bad. 1.6% for private sector wages and salaries. That's much higher than the Fed can tolerate. And so I think they have to stick to it. I'm really surprised we haven't seen a repricing of the September FOMC from 50 to 75. I suppose there's a lot of data between now and then. But if the Fed's going at 75 basis points for the rest of the year, that puts that severe recession scenario back on the table. And it means that where the markets are pricing right now is just not right.
I think the reaction function is clear as mud. And Brian, that's part of the problem, isn't it? We all know what data to look at. We just don't know why it matters so much anymore, because they flip from one thing to another. ECI to UMich, headline to core. And we're going to have to wait for the Fed speakers to tell us. The Atlanta Fed president this morning, I think, told us, I don't know if we were listening, basically said the economy's resilient and we've got more work to do. Amazon's up 12%, Brian. Apple's up by 3.5%. It's a pretty powerful move over the last 3 days. Tell me how you'd use this strength to reposition. That's a question I asked Tony Dwyer. Let me finish up with you and ask the same one.
Sure. So I would say, without getting completely defensive and moving into the really low growth areas, I think we're moving up in quality across every asset class. If you ask us what our highest convictions are across the board, we'd actually say at this point it's probably municipal bonds, corporate bonds. So we have an overweight to bonds versus stocks right now. That was before this move. So I think our conviction is probably increased maybe just a bit further. That means we are positioned for a macro deterioration. Being long duration, for example, is going to help you, we think, if things turn over quickly. But all of these trades are still exposed to the further lurch higher in rates and a repeat of what we saw in the first 6 months of the year. We know from experience there just aren't that many hedges for that scenario, which is why what we are seeing, the moves we're seeing in these higher growth companies at this point, is nice to see from an earnings perspective, but also somewhat concerning from a valuation perspective.
Brian, Nick, the easing of financial conditions and whether this Fed's going to push back in the coming weeks is going to be interesting. Brian, Nick there at Nuveen. Good to catch up, buddy, as always. Up next, your trading diary as this market moves into a third straight day of gains. This is Bloomberg. We are looking at 3 days of gains. Will it stick? About 26 minutes in, stocks higher by 0.7% on the S&P. That's the price action. Here's the trading diary. Top of the hour. University of Michigan Consumer Sentiment Survey. Then next week, ISM manufacturing numbers Monday. Fed speak returns with Evans and Bullard on Tuesday. A Bank of England rate decision coming up on Thursday. And finally, really already, it's the payrolls report next Friday. I had no idea. From New York City, thank you for choosing Bloomberg TV. I'll see you a little bit later for Bloomberg Real Yield. If we miss each other, have a wonderful weekend. This is Bloomberg.